All right, well, let's get digging in the resources sector, and to do that now we're joined by Sean Hickman, Research Lead at Market Matters. Sean, good to see you again. So you're kicking the dirt at the moment.
Nice to be here, Andrew.
Yeah,
to a certain degree, yes.
Yeah, well, because that's clearly a sector you're favouring at the moment. Why?
Well, we've been overweight tech and overweight the resources for a while now, and I think it's the combination of two factors. We saw the market was underestimating the recovery potential, and secondly, they were just heavily underweight the overall sector. I've mentioned that before. The Bank of America Fund Manager Survey told us where people were positioned. They told us they were short the US dollar in a massive way. We've seen that unwind in the last couple of weeks. So that in itself is very, very bullish for commodities, and they popped accordingly. You know, Samfar's popped 25-30% in a couple of days. We've seen the same thing. We haven't seen the same thing unfold yet, I stressed it, in the tech sector. But if everyone's positioned one way, Andrew, and the market starts to shake the leaves in the other direction, you get some dramatic moves, and that's what we've seen happening here. So the resources, they pull back. To our point of view, they got too cheap. We were happy to go along. But this is a rotational sort of market. You know, I've been on the show with you now for the last few months saying we were bullish. I know you looked at me strangely a few times when I said that. But here we are. My target the whole time was 7,200 for the ASX 200. I heard you ask the previous guest his target. And we hit 71.96 yesterday. So that actually offers a bit of a quandary to us. It's like, okay, it's already hit our target and we're not even in December. So I think we're going to see ongoing sector rotation. And it's a really fascinating time in the market with the resources probably front and center in that space.
So are you in that camp where you feel that this is the beginning of a new bull run rather than yet another bear market rally?
No, I'd probably, if you put me on the spot, I'd say more of a strong bear market rally. Mainly because the market's gone up for many, many years and it just needs to go sideways for a few years, to put it cornily. In the term of the resources, I can see them going higher, but we're long. I think the easy money, if such a thing does exist nowadays, is behind us. This is the time to sit back and stay long, monitor positions as opposed to jump on and be aggressively buying today, which I think what you were sort of asking me before.
Okay, so yeah, we've just seen a couple of the charts there for the share price. You mentioned Sandfire, that's done extremely well. So when you look at the likes of copper, iron ore, and bearing in mind what's going on in China, given the huge demand that country sucks up, you're sounding as though you're pretty bullish on that front. We're
relatively bullish, Andrew. I clarify that. The market is now, started to factor in a lot more good news than it was 2 months ago. And there are a lot of moving parts that you just alluded to then in this equation. So China's one of the hardest ones to pick because they've come out with a lot of different noises and rumours and innuendos over the last few weeks. But the bottom line was, a few weeks ago, everyone was talking about COVID lockdowns, China was doing nothing. And now it sounds like they're trying to open up a bit. We've got Xi Jinping meeting Biden this week. And I think that at some stage, who knows exactly when, they will start to kickstart their economy again. They've come in with come out, I should say, with a housing package rescue of sorts. And I think it just seems that they're going to start to crank up their economy again, which of course is very good news for those materials. But again, they've already bounced a long way in anticipation of that. And very importantly, the US dollar falling.
So with you favouring BHP Fortescue, what are you seeing with the iron ore price then?
Well, BHP is one of our favourite companies. We're still holding a lot of BHP in our portfolios. But BHP, again, has been in the same trading at $17, which is a big trading range, for the last few years. We'd have no hesitation in lightening BHP in that $47, $50 range, just like we think under $35 is a good buy. All things being equal right here, right now. It's a cyclical stock. And with cyclical stocks, things move, things change. The price of iron ore could halve or it could double, as we've seen in the last few years with both basically happening. So, BHP is a quality stock, but we still will, everything being equal, look to lighten it into strength. That strength isn't yet close by, but it could easily be on the horizon into Christmas.
More specifically, IGO in the nickel space, Iluka, rare earths, what are you seeing there?
We're long, got a very good position in IGO that's really looked after us this year. Just a little bit nervous about how crowded the ESG space is. So we're holding it at the moment, we're watching it very closely. We've seen, again, as I mentioned before, we've seen some sharp reversals in crowded trades over the recent weeks. One of them, obviously the US dollar, which is the biggest one, which has driven resources higher, broadly speaking. So we're long IGO. It's a quality company. We like the timing of their move and their expansion. Nickel, everything they're doing looks good. But at the end of the day, it also comes down to valuation. So we might take a bit off the table into current levels, but we're still happily long. But it's a balance about risk-reward. It's quite a boring one, risk-reward, but it's there. Coming back to your previous question, specifically on iron ore, looked great 2 weeks ago. Obviously now Fortescue has run very, very hard. The risk-reward again isn't quite as attractive, but into pullbacks, I still think that space could outperform the market.
Iluka?
Iluka, interesting one. We're long Iluka. I wasn't very happy about it a few weeks ago. After they reported, it got sold off quite savagely. The mineral sand space does look a bit mature. Also, of course, it will be a rare earths play further down the track. We're staying with it. It does dovetail with our bullish outlook for the material space into Christmas and early next year. But again, it's very much part of that equation I said before, Andrew. We're happy to stay long. We've been long for a while, but it's not the time to be jumping in and buying a great deal more, I don't believe.
Yeah, I mean, you've underlined that this is all, you're talking long, this is very long-term plays. That's what you're saying as an investor, you sort of need to be thinking, I guess, looking beyond the valley as to where rates are at the moment and where the economy is likely to track if you're going to make, I guess, broad appreciation in your portfolio, but it is perhaps you're not going to get those immediate returns that you had in the past few years.
Totally. I mean, we're active investors, is a word I would definitely quantify that. And as such, we are seeing stocks move, we saw with Samphire, 25-30% in a couple of weeks. So these are huge moves. One has to say, okay, is it worth taking a bit of cream off the top of the cake? Doesn't mean you necessarily get out of Samphire, but we're holding 5% of our portfolio in Samphire. Is that too much now? It's rallied so hard. These are the ways that we start to play on the portfolios, or tweak, I should say, rather than play around our portfolios, because the market is moving fast, it's moving hard, and one has to be very open-minded to where the next 500 points will be. We might have bounced 500 points fairly quickly, doesn't mean the next 500 points will be down as opposed to up. Conversely, say the FTSE, which is it's an interesting one as well. The FTSE, UK FTSE, is a resource-based, a bit like we are, a lot of resources in its index is only 4% of its last few years' high. It's almost at an all-time high, whereas the S&P 500 is 17% of its high because it's a high-tech component. So there's a huge amount of moving parts out there, but rather than say, I'm bullish, it's like, how are you bullish here right now in this area?
So when you compare those equity markets globally then, how well placed is Australia?
Pretty well. At the moment, right here, that's why we haven't done too badly of late. Our tech sector seems to make up more of a sentiment as opposed to a huge part of our index-driven part of the market. We thought by now tech would be picking up, especially after some of the more dovish, or should I say less hawkish comments out of the Fed. It hasn't got there yet. People are still nervous of tech, still nervous of valuations, and we might have that one wrong. Time will tell, hopefully not. The resources has dropped the right way. People are still scared to buy tech.